Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the 6th episode of our InvesTips from the CIO's Desk series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and the host for this series. In the last episode, we discussed a key driver in why investing is so important: the likelihood that inflation will erode your savings massively over time. Today, I want to talk about something that can lead people to delay their investment journey: the fact that investing your money always leads to some risk. Now, we know risk is an unavoidable fact of daily life. For instance, we all know that if we step into a vehicle, there is a risk that you'll end up in an accident. However, this risk doesn't stop us from using cars, buses, trains or planes to move around. The benefits outweigh the risks, and they are a part of our daily routine from a very young age. However, investing is not something most of us experienced as we were growing up, nor is it something that we were generally taught either at school or at home. Meanwhile, the financial industry has a way of making investing sound complex and using different jargon. And risk is a great example of this, and this can scare away many potential investors from starting their investment journey. However, as we discussed last week, inaction creates a different risk, that is, inflation eroding the value of your savings. Therefore, risk is something we need to address head on. Now, there are two broad sources of risk when it comes to investing: systematic risk and unsystematic risk. Systematic risk is something that will impact the whole financial system, and variables such as economic growth, inflation, and interest rates lead the way here. Unsystematic risk, also known as idiosyncratic risk, are linked to factors that are specific to a certain asset class, industry, or company, such as competition, market demand, and management effectiveness. So how do we quantify risk? Well, there are many measures. In finance circles, standard deviation or volatility are often used. However, one very useful metric when looking at a portfolio is the concept of maximum drawdown. This is useful because it helps people get a perspective of what has been the worst peak to trough decline in the value of a portfolio from a historical perspective. There's no guarantee that it will not be bigger in the future, of course, but it does give you some guide, especially for more diversified investments. For instance, if you look at the global equity market, the maximum drawdown since 2000 was 55% in the global financial crisis, and it took us almost 6 years for the market to make new highs again. Now, if you would get nervous with such an outcome, to the extent that you might decide to sell even after steep losses, then it would be wise to diversify into other asset classes in order to reduce the maximum drawdown to a more comfortable level. Therefore, when looking at an investment, getting a sense of what the maximum drawdown has been is a great starting point. Ideally, the maximum drawdown calculation should be applied across your whole investment portfolio, because this should better reflect the diversification benefits of having different asset classes, rather than assuming that every individual investment will experience its worst peak to trough decline at exactly the same time. For instance, often bond markets will rally when equity markets are weak, and vice versa, and this reduces the maximum drawdown at the portfolio level. So therefore, this all comes down to trying to understand ahead of time how you will feel when your investments have lost value. Now, we have to acknowledge that this is impossible to do ahead of time. Indeed, even for the same person, how you react may depend on where you are on your life journey. It might have a much greater psychological impact on you if it happens right at the start of your journey, or even as you approach retirement. Whereas if it happens in your mid-40s, when you have surplus savings, that might be much less of a concern to you because you can take advantage of the depressed prices by investing more. So we say this is impossible, so how do you actually do this? So I believe that the best thing to do is to guess how you would feel. Start investing and then learn. If you're nervous, maybe take a little less risk at the start so that you can always understand market fluctuations and your psychological reaction to them over time. Thereafter, you can always increase your risk profile as you go along, and the sooner you figure out how to manage the risk-return trade-off, the easier it will be to meet your financial goals without severe accidents along the way. So that's all we're going to cover today. In the next episode, we'll discuss the different objectives of investing, as well as other reasons people sometimes invest less than they should. Thanks so much, and I look forward to catching up with you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.